Well, the stock market soared as the U.S. and China agreed to roll back tariffs imposed.
Look at these markets. These markets are as green as Dan's jacket.
A pair of dramatic White House announcements adding rocket fuel to the markets today.
And the Dow surged more than 1,100 points yesterday with the U.S. and China agreeing to that dramatically reduced tariffs.
Everyone is watching it. A $54 trillion asset class has been recovering after a crash with a violence only comparable to the pandemic and the great financial crisis. A record 60% of households have exposure to the stock market today, and the question that's on everyone's minds is whether this rally is actually sustainable. Well, we're going to be diving into the hard historical data in order to answer that question in this video. First, let's establish the three potential scenarios that are in front of us. A V-shaped recovery, with stocks immediately recovering back to their highs and resuming their bull market. A deeper pullback, taking the stock market down past the low it made on the 7th of April. And finally, a consolidation, where price stays within a range for weeks, perhaps months, before eventually resuming higher. We're going to look at each scenario to understand what it would take in order for these to happen, and more importantly, evaluate which one of these is the likeliest to occur today. Let's start with the possibility of a V-shaped recovery. In order for this scenario to take place, we basically need to see a 180-degree flip on the economic outlook. This would basically mean that all of the concerns that were priced in during this correction at the beginning of 2025 would completely disappear into irrelevance over the coming weeks and months. The news of a trade deal between the US and China is leading many to believe that the skies are clear for stocks to continue moving higher from here. And indeed, we've seen this kind of V-shaped recovery happen before in history. The most recent example is, of course, COVID, where the stock market crashed by 35%, only to snap back up all the way back to its all-time highs almost in a straight line. We also saw this type of distinct V-shaped recovery towards the end of the great financial crisis. Within just a few months, investors went from expecting a total collapse of the financial system to expecting a very strong rebound in economic growth. The problem is that in both of these V-shaped recovery examples, huge amounts of monetary stimulus were likely responsible for these V-shaped recovery rallies. We can see this by simply adding the US Federal Reserve's balance sheet, which reflects how much liquidity the Fed is injecting into the financial system. And we see that the two biggest jumps in liquidity injections occurred right before these two V-shaped recoveries. And this is not something that we're witnessing today. So the V-shaped recovery scenario is already off to a bad start. But it's not all bad news for this scenario. There are some things that are going for it. For instance, stock market earnings, so how much money companies are actually making, have been very resilient despite the 20% drawdown in the stock market. This chart shows us the earnings per share estimates of the S&P 500. And if we zoom in closer on the 2025 earnings, we can actually see that earnings estimates are higher today in May than they were in January before the correction started. At the beginning of the month, giants like Microsoft, Meta, Apple, and Amazon all reported stronger than expected earnings. And there's some real driving factors that are pushing these earnings higher. The weakness that we've seen on the US dollar recently is helping make the international revenues of these companies look bigger. A weak US dollar also has a stimulative effect on the economy. We've had lower gas prices that have helped keep consumers' heads above the water. And the Federal Reserve has been lowering interest rates over the past year, which could also be starting to have some stimulative effects on the economy. These are all factors that we've been talking about over the last few months and explain why the stock market and stock market earnings have been so resilient in 2025. But none of these factors are stopping the storm that is brewing right over all of this. Tariffs are being implemented. As of now, the United States has imposed an average tariff rate of 3.6% on China. This is a brand new number calculated following the new negotiations that have taken place. The US Treasury Secretary has mentioned that this number would be the floor for tariffs on China. They've also imposed an average 3.4% effective tariff rate on the entire world, plus a 3.1% reciprocal baseline rate, plus 0.4% specifically on Canada and Mexico. Now, while these are much lower numbers than what many were initially concerned about, they still impact roughly $2 trillion worth of trade in total, which would have an estimated impact on GDP of about a 1.5% contraction. For reference, the Great Financial Crisis saw US GDP contract by about 3%. So although tariffs may not trigger a full-blown recession, it's very likely they will slow the economy down, and that, in our opinion, reduces the odds of the V-shaped recovery scenario happening. Now, just because we don't believe this scenario is the likeliest, doesn't mean that we're going short on the market right now. If you want to have access to our entire allocation strategy, we share every detail of it to our clients at Bravos Research. We've made double-digit gains in the last couple of months on trades like BYD, gold, NRG, ADMA. The markets have been presenting plenty of opportunities to take advantage of, and there's going to be plenty more in the rest of 2025. So if it's not going to be a V-shaped recovery, are we going to see a much deeper pullback on the market? Well, in this scenario, we need to see things deteriorating. Or to put it more simply, things need to get worse than they are today. There's many examples throughout history where things have gotten worse, even much worse, after a brief market bounce. A great example of this is in May of 2008, where the stock market rallied significantly after a deep stock market correction, but eventually the rally failed and the stock market took out the previous low, declining much further in the months that followed. The same thing happened a few times in 2001. The market rallied off its lows a few times, but each time the economic situation deteriorated and the stock market eventually rolled over and went down much further. If this scenario were to happen today, I believe most people are aware of what that would mean. It's what everyone has been talking about non-stop since the whole tariff situation started. In fact, we already had the first negative quarterly GDP print for the first quarter of 2025. If we zoom out, we can compare this, for example, to the first quarter of 2008, where this negative GDP print was the first of multiple negative GDP numbers that followed during the duration of the Great Financial Crisis. Or we could compare it to this reading from the first quarter of 2001 that was also followed by an additional contraction in the economy. Both 2001 and 2008 are examples of actual economic recessions, and the stock market suffered much larger drawdowns during these periods, north of 50% contractions. Seeing further contractions in GDP today would also mean the stock market could experience a much larger decline than what we've already seen. But as you may have noticed, we've also seen negative GDP prints occur outside of economic recessions. These are isolated episodes of economic weakness, like in 2022, in 2014, and in 2011. All of these were actually great moments to be buying stocks in order to benefit from the economic growth that followed. The difference between these singular GDP contractions and these clusters of GDP contractions can be summed up in one word: layoffs. When we look at initial jobless claims in the United States during the first quarter of 2001 and the first quarter of 2008, which coincided with those initial negative GDP prints, we see that initial jobless claims were rising in a material manner during these periods. In other words, layoffs were picking up. When we look at what initial claims were doing in 2022, 2014, and 2011, which correspond to those isolated negative GDP prints, well, we see that they were generally stable. Layoffs were not picking up. And today, the truth is we have not seen any sort of pickup in layoffs despite the negative GDP print. Could layoffs begin to pick up over the coming months as we see the impact of tariffs take place? Sure, but right now the truth is there is still a very real possibility of the economy avoiding a recession, especially if those factors that I talked about earlier, low oil prices, lower interest rates, and a weak dollar, help stabilize the economy and stock market earnings. So that leaves us with the last possible scenario, the consolidation or partial retracement. This is where the stock market would basically chop around for a while, digesting the bad news, but the economy avoids a recession in 2025, and eventually the market looks to a brighter future. We've seen this happen many times in the past. A great example of this is 2011. Following a 20% decline as a result of the European debt crisis, the stock market consolidated for multiple months, digesting the news before ultimately moving higher. The same thing happened in 1998 when the Asian financial crisis triggered a 20% stock market correction, raising recession concerns. The stock market chopped around for a few months, digesting the news, but the economy did avoid a recession and stocks were able to recover. In our opinion, it might be boring and it might get less views, but that's the scenario that we think is the likeliest today. A great way to think about it would be to say that the uncertainty from tariffs caused a temporary economic slowdown, but have not yet triggered a full-blown recession. If the economy avoids a recession in 2025, although the market could continue chopping around, it would eventually recover back to its highs. Luckily, we don't need to be able to predict the exact path of the S&P 500 to profit from markets. We've made easy profits over the last couple of months. We just booked a 50% gain on NRG and a 17.5% gain on ZGen, and we just initiated a trade on IHS that's already up over 10%. If you want to catch our next trades, make sure to go to our website and test our service out.